Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, August 23, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was another quiet day today across the majority of the markets out on Wall Street today. Part of it is the summer doldrums. Part of it is the lack of volume. Maybe they're one and the same. But at the end of the day, unless we get a pickup in volume, there's unlikely going to be a lot of downside in this market. What I always say is the path of least resistance in light volume is to the upside. Right now, we're seeing light volume, and therefore, not that we're going up each and every day, but we're going sideways. And what does sideways activity tell us? Sideways activity tells us that the market is going sideways in order to eat some time off the clock, to build some energy, to make another or continuation move to the upside. That's the majority of the time what happens when we're going sideways. Now, can we come down farther than we are right now? Can we go sideways, setting up for another move higher, but still come down farther than we are now? Well, that is possible. What I'd like to do right now, since there's just not a lot of activity across the markets today. I mean, the S&P 500 was down 5 points today. The Dow Jones Industrial Average was down 76 points. It's 1/3%. The S&P is less than 0.2%. There's not a lot of movement out here. There's not a lot of change from 2 days ago. There's not a lot of change from yesterday. And so what I'd like to do is let's just take a walk around and look at different charts to see if we can get a clue, looking at different charts from different perspectives, see what the evidence is telling us from around the world. Before I do that, let me take a pause and just thank everybody for continuing to participate and make comments and postings underneath the videos. They're helpful to me. They're helpful to the entire community. There's a lot of really good information that a lot of quality and smart traders are posting out there. So please do keep up the great work. I do appreciate the comments. In addition, hit the like button and share the video with those people you think that can benefit from this information. All right, back to the Spider. So let's start with the weekly chart and see if there's any kind of material change or if we can see anything that might give us any kind of A, cause for concern, or B, are we in a clear indication that the market's moving higher? Well, we're certainly in an uptrend. There's no indication for cause for concern. This is in an uptrend. That's all there is to it. We'll see what happens where we close the week tomorrow, but I'm not thinking we're going to get any kind of a tremendous move one way or the other based on tomorrow's activity. Anything's possible, but based on the weekly close, we're in an uptrend. The market continues to grind higher. We did, from an intraday perspective, make a new high. That's against these highs that were made all the way back in January of this year. So we made an intraday new high. We have yet to make a closing high. That's certainly possible. Back to the daily chart. The question is, are we going to come down a little bit before we go up higher, if we're going to go up higher again? So here's an up move, and now you can see we're beginning a consolidation phase. Now, does the consolidation phase take us down farther, and then we have another move higher? Or do we just move higher and then have another move higher? Or do we just fail altogether? Well, we can't really answer that question with definitive results, but what we can do is look at other charts. Let's look at the 60-minute chart. What is the 60-minute chart telling us right now? Well, we do have a breakdown candle, and we have been, since the formation of that breakdown candle, we've been going sideways in a bear flag pattern. What does that normally tell us? A bear flag pattern tells us that we're likely to see a continuation move, in this case, to the downside. Where would that put the Spider if we had a continuation move of this bear flag pattern to the downside? Basically, it takes us down to 285, down to 284.95, give or take. That's the 50-period moving average on this hourly chart. That would technically be a completion of this bearish pattern on the hourly chart. You see, that would be what they call market symmetry. So we have a down move, we have a sideways move, and then we have another down move that's basically somewhat equidistant to the initial down move, and that brings us right into the moving averages. So that's where we are based on the hourly chart. Could we go lower than that if the market decided to sell? Of course we could. We have an important pivot low down here. That comes in at 284. Well, that's about another dollar lower than the 50-period moving average comes in. So there's 285, 284.95. There's 284. You have gap window down here slightly below that. We'll call it 283.5. There will be some support there. Then you have another important pivot high down here at 282.5. You have a gap fill down here all the way below 281. Now, I'm not expecting all that to take place tomorrow. I'm just telling you where the important support areas happen to be. But we take it one step at a time, and right out of this pattern here, a technically sound completion would be right into these moving averages right here. Give or take 20, 30 cents. 285 is the number, and that would complete this bearish pattern on the hourly chart. The IWM, this is the daily chart. Now, what you'll remember from a couple of days ago is we made a new closing high. So as a result of a new closing high, you can see with the IWM right here, all we're doing is going sideways. What's that doing? Yes, you know the answer. Building energy, buying time off the clock or eating time off the clock, building some energy to push again higher. It doesn't have to happen all at once. The market easily gets overbought or oversold on a short-term basis. The IWM got overbought on a very short-term basis, a little bit extended from home base, the 20-period moving average. So let's eat some time off the clock, maybe even pull back a little bit. But we did make a new closing high that is bullish. We are in an uptrend, and therefore there are likely higher prices coming. Again, doesn't have to be up each and every day, but there are likely higher prices coming. How about the VIX? So the VIX was up slightly today. It was up, it was down. It was only up a little over 1%, 16 cents. That's not a big deal for the VIX. We are below all the moving averages. Here's what I want to point out. We had that spike several days ago in the VIX, but here's what we have. So we have an up move off the lows. We have a pullback pattern. Now this can completely continue down farther to the former lows from a couple of weeks ago or even lower. What I'm just suggesting is just keep your eye out for another spike higher. There is a possibility, there's always a possibility that this is an ABC pattern that would technically complete above the high of the A leg. That's always possible. That's a tall order. It's a lot to ask of the VIX. I'm not suggesting, nor am I forecasting, that the VIX is going to go all the way back down toward or up toward 18 right now. We're at 1241. That's not what I'm saying. I'm just saying until and unless we close below on the daily chart 1159, that's a line in the sand. Until we close below 1159, we can still be susceptible to higher prices in the VIX. 1159 is right down here. We made a low today of 1165. This is a breakup candle. We tested the breakup candle low. We traded away from it to the upside. Does that spell lower prices for stocks across the board tomorrow? We don't know. We'll see. I'm looking at each individual chart in and of itself, and what I'm telling you on the daily chart of the VIX is we're bearish below the moving averages, but still maintaining daily closes above 1159. That still can be looked at from a bullish perspective for the VIX, lower prices for stock prices. It's puzzle pieces. It's on the table. We always put the puzzle pieces on the table. When the picture becomes clear, we likely have a better idea of what the next major likely move in the market will be. Right now, we have an hourly bearish chart of the spider. We have a potential interesting setup on the VIX as long as we still maintain daily closes above 1159. And that's what we have. I'm putting these pieces on the table with everything else we have, and we'll move along and look at other markets. How about the transports? Now, the transports We're also on a little bit of a runaway similar to the IWM. And you know the IWM and the transports, my number 1 and 2 favorite market leading indicators. So we had a couple of down days in the transports after the breakout from the former highs. Where are we? We just came back down to backtest the former breakout area. Here's what I mean by this. I say this each and every night. Doesn't even matter what chart we're looking at. We find them on all the charts. So what happens is the market breaks out. First, it makes a high and we trade away from it. We get rejected at that high. Then the market takes another run for those highs and breaks above the highs. We get above it for a couple of days, and now we come back to test the breakout from where we broke out from the former highs. And that's exactly what the market just did over the last couple of days. We came back to test a former breakout level. That's it. Nothing more, nothing less. Can it go down farther? Of course it can. I'm just telling you what happened based on the last couple of days of activity and why we stopped where we did today. The former high was 11,253. Today's low, 11,243, closing above the former high, 11,260. That's not an accident, nor is it a coincidence. There are no accidents, no coincidences in the markets. How about a chart of the Qs? Are the Qs telling us anything? Not really. We're above the moving averages. We are consolidating. I can make a case that because we closed back above the high of this breakdown candle, we're just consolidating to make another push higher. We've seen that over and over and over again. That's not new information. However, if we do get below these moving averages and begin closing them below those moving averages on a daily basis, that could be problematic. So we'll take that one day at a time. But technically speaking, you know the deal with the Qs. When you look at the long-term chart, there's nothing wrong with this chart of the Qs. Even if we came down a little bit, there's a lot of space in between the 20-week moving average and where price is now. There's about $7 in the Qs in between the 20-week and where price is today. So there's a lot of what I like to call white space in between. To put that in perspective, that's all the way down here, just above the 100-day moving average. Now, that would be a failure on the daily chart. Do I expect that to happen? Not necessarily. There are a lot of support areas in between 173 or 172, where the 100-day moving average is on the Q chart, and where price is now. Just for one, we have the 20-period moving average. We have the 50-period moving average. We have these pivots down here that come in at around 178. We have this breakup candle low. That comes in at 175.79. There's a lot of stuff from a support standpoint in between the 20-week moving average and where price is right now. So my expectation is not to come down anywhere near the 20-week moving average anytime soon. Could we come down a little bit? Sure. Could we come down to the 20-period moving average? Sure we could. It's only $1 away from where we are. Could we spike through it on the downside a little bit? Absolutely. We'll see what happens. Anything goes on a Friday. Normally, we get what I like to call the Friday float. After the morning session, after about an hour and a half or so in the morning, we generally get very, very quiet activity across the markets, and the markets generally just float around back and forth, most likely caused by computerized trading. Nothing more, nothing less. Doesn't have to happen every Friday, but does happen a lot of Fridays. Now, since we just looked at a chart of the Qs, I'm going to show you an intraday chart of the NQ, which is the E-mini contract that covers the NASDAQ 100. The reason why I want to show you this is because I want to show you where I picked up a trade, why I took the trade, where I exited the trade, and why. The trade was this afternoon, right in the neighborhood of 3 p.m. Now, around 3 o'clock and after, I start to get a little bit weary about taking trades, only because time is running out, and I don't want to be stuck in something going the wrong direction and have to take a loss because time ran out on the clock. But nevertheless, it was a trade I was completely willing to take. Let me explain the setup. First of all, what we're looking at here is the NQ continuous contract. The pit session contract looks basically the same. I'll show it to you. The chart looks, for the most part, the same. But for whatever reason, I'm looking at this one right now. And let me show you the trade setup. So right now, we're focused in on this area here. Okay, so 3 o'clock in the afternoon happens to be right here, that candle. I'll get back to that in a minute. Let me backtrack and explain what was happening. So the chart of the Qs broke down. So we had this long drawn-out breakdown earlier. Then the Qs begin to recover. Now, we can talk about, was there support in here? Was there a trade in here? There may or may not have been. That was not the point of this particular lesson. I want to show you a different trade. There was support in here. There was other stuff going on in here. We can talk about that. I was going to say another time, but we'll talk about it right now. Basically, that was an area, that was a buy level. Traders that have taken the course at lazyeMiniTrader.com understand why that was a buy level and where it comes from. The buy level in this particular case was right around 74.20 in the NQ contract. And any trader that has taken the course at lazyeMiniTrader can certainly email me if you're not familiar with why that was a buy area. And from this morning's perspective, it was a tremendous buy area, gave a nice big bounce. And then where do we like to sell from situations like that where we bought low and we want to sell into strength, but we're not sure exactly how high the market can go? This gets into a couple of other discussions. Number one is, how do you trade using multiple contracts, or if you're using shares, if this was a stock, is we can take off part of the position. I teach how to trade like that in my courses where you give yourself an opportunity to get the best of both worlds. You can turn trades like this into risk-free, emotionless trades. Let me just give it to you real quick. I didn't intend on doing this, but I'll do it anyway. So let's say we're buying in here at 74.20 in that neighborhood. How do I know where to sell? Well, number one is I'm buying multiple contracts. That means I have the ability to take off a piece of the trade. One contract, two contracts, whatever the case is. If I'm buying two, I can take one off. If I'm buying three, I can take one off. If I'm buying any other number, I can take a portion of the trade off on the way up. What that allows me to do is turn the trade into a risk-free, emotionless trade. Again, if you're unfamiliar with how that works, it's in the course. It's actually in both my courses, Lazy Gap Trader, Lazy E-Mini Trader. I don't want to get sidetracked on that right now. What I do want to show you, and you'll see this, and you've already seen this, I'm sure. Here's the top of a breakdown candle. You didn't get to the top of that breakdown candle on that run, but as you're looking to scale out of a position, that's the area where you know you're going to find resistance. So either in front of or right around that area is the area that you would likely have to start selling, or at least get finished selling from an entry, in this case down at 74.20. From a buy down here, you start to sell towards the top of the breakdown candle. Now let's get back to the trade that I actually wanted to talk about. I got sidetracked, got on a soapbox. Sorry about that. This is another pattern that's taught in the course at Lazy E-Mini Trader. It's basically a pretty easy pattern to spot and identify. We spot them all the time. It's a consolidation pattern. It's an inside bar pattern. You can give it any name you want. There's a lot of different names floating around technical analysis for what this pattern is. But the reality is here's the way it works. So go back to the breakdown candle from before. We have a breakdown candle. So what was the market likely doing is it tried to get through that breakdown candle, couldn't do it. It began consolidating. So we had this, see this green candle? That's a breakup candle. So here's the bottom of the breakup candle. We tried to break out to get above the top of this breakdown candle. I know this might sound confusing. Rewind the video a couple of times if it is. So we tried to get through, we couldn't. So price was rejected at the top of this breakdown candle right here, okay? So what I figured was happening was we were consolidating for a while. So I said, well, a good buying opportunity would be close to the low of the last break up candle. This is now fast forward. I'm already at 3 o'clock in the afternoon today. Here's the low of the breakup candle, and you see this candle here, right here at 3 o'clock in the afternoon. That's the 10-minute candle ending at 15 o'clock, if you will. So that's 3 o'clock in the afternoon. So what I do, I put an order in at the low of the breakup candle. The low was 74.38 and a quarter. The low of this candle here was 74.38. So I actually got it a couple of ticks above that. And as the market recovered, I figure, hey, this is going to be a home run because, and again, traders that know and understand everything that's discussed and taught in the course at Lazy E-mini Trader understand from a time perspective also why I bought when I bought. Why was that important around 3 o'clock in the afternoon? They know that. So traders that have taken the course know that. So I figured this is going to be a home run. Price is going to break up. We're going to get through. We've been consolidating to build energy to get through this former breakdown candle high. We have a breakup candle. We're just consolidating. This is going to go all the way up to something in the neighborhood of 74.55, 74.60 by the close. That's what I figured was going to happen. So let's just say for argument's sake, I had 2 contracts. So the market starts to bounce higher. I take one off. I have a break-even stop. It's a risk-free, emotionless trade. And here's the deal, and there's 2 things going on, and I know what some of you are thinking, and I am going to answer that question. So the question is, I had a break-even stop, but what I teach is, so we're looking for a close below for a failure of this bullish pattern. We're looking for a close below the low of that breakup candle. Here's the problem. It was late in the day. I already had a positive trade on. I'm not looking to put on a lot of exposure or risk late in the day. I've already had a positive trade. I took half the trade off. I'm not looking to take a loss, so I scratched out of the remaining portion of the trade with a break even at that low or around that low of the breakup candle, and that's the end of it. And you can see what happened. This candle here puts in a tail candle. Looks like I was going to be wrong for scratching out of it. The remaining portion looks like we were going to break up, and then what happened? We broke down, and what happened? We closed below, and that all happened in one shot, but you can see what happened. When we got back below the low of that breakup candle, now technically you have to wait for the close, but it's late in the day, and who wants to wait for the close? It was already taking place. You had 20 minutes left in the day at the point when the market was breaking down, but that's how we lose small and fast. That failure of that breakup candle low, okay, was what was telling me I didn't want to be around anymore. I already got a small profit on half of the position where I thought it was going to break up and be a consolidation pattern that breaks to the upside. It didn't happen, so I got stopped out of the second half of the trade. That's okay. That's the way it works sometimes. It happens. But guess what? I had a profit on the first half, and I lost with a break even on the second half. No harm, no foul. This is Trading 101, folks. This is what I teach in my course. Things like this. How to lose small and fast. When to enter a trade. Why to enter a trade. When to enter a trade. I teach all these patterns that repeat on the charts over and over and over again. Everything you want to know is taught in the course at LazyEMiniTrader.com. All right, got to get back on track here. Here's the XLF. No new development in the XLF. We're still above the moving averages. We had a down day today, not by a whole lot. We're just down from where we were yesterday, a few pennies. Nothing more, nothing less. We're above the moving averages. As long as we stay in this range up here, we're just going back and forth, trying to consolidate, build some energy to do what? Get through these prices here. That's what this is trying to do. Nothing has changed in the XLF. Going to jump over to gold real quick, and you can see what's going on here. We had the tail candle from the other day. This is from the 16th. We put in the tail candle, so then we're looking at getting up to around the 20-period moving average if, in fact, we're able to get above and close above the high of this last breakdown candle, 1202. Pretty interesting what happened, right? Yesterday, we closed at 1203, $1 above the high of that breakdown candle, sorry. Here's the open at 1203, the close at 1203, and today we're already breaking down again, down another $11 in gold. Here was the point in gold. It was a dead cat bounce. We talked about it being a dead cat bounce. Maybe we go higher. We got to around the upside objective that I thought we would on the upside, maybe a few dollars short of it. Thought we would get up to the 20-period moving average. We came up short. Now we're potentially failing again. Again, I wasn't long short. I'm not short. I'm not long gold. I'm not short gold. I have no dog in the fight. I'm just an umpire calling balls and strikes. It's in a downtrend. I don't like it. It's just good for maybe some dead cat bounces. You can trade off of these tail candles when they do appear. That's it. Nothing more, nothing less. Crude oil. Crude oil's interesting here. We had the big up day yesterday, which negated the bearish pattern that we were working from a couple of days ago. Now we're back to this high over here, 68.79. That's the line in the sand. As long as we maintain the level below, daily closes below 68.79, so less than $1 away from where we are now on the upside, that's going to keep the pressure to the downside of the crude oil market. Any close above the high of 68.79, that's going to be positive for crude oil. Same routine. We've done this before. It's over and over and over again. All charts act and react the same way over and over and over again. Anybody that wants to learn the ins and outs, how this really works, become an efficient and profitable trader, come over to check out the course at lazyeMinitrader.com. You can do it. Anybody can do it. If you have the desire and the discipline to learn this business, you can do it. You can be profitable. You can take it one day at a time. One day leads into a profitable week, which leads into a profitable month, which leads to profitable years. And that, my friends, is a business. I'm out of wind. I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.